Well, good afternoon. Good afternoon and welcome to another of our webinar Wednesdays hosted by Cal State Bakersfield Small Business Development Center. I'm Kelly Bearden. I'm your host and your action presenter today. As I step into this role as well, the dual role, triple role if you call, even include the director of the CSU Bakersfield Small Business Development Center, or SBDC. Hey, we got a really interesting topic, I think, today. Very trending topic, evolving topic, something that's changing all the time and will be probably obsolete in another couple months. Who knows? But it's what's happening now in the AI and using and how it improves or diminishes your chances for small business funding. So AI is impacting everything, it seems like, in the business world. But of course, it's going to impact small business funding as well. So we're going to look at kind of three general ways how it is going to do so. The three general ways it's impacting, um, small business lending is going to be and how it impacts the borrowers. So it's going to be borrowers out there and how they're impacted by it, how it impacts lenders, and then how it impacts the future and also the very near future and trends that you might need to be aware of, particularly if your funding is a few months away. We're going to be, going through our three usual staples, our three columns that we have here as part of the pillars of Webinar Wednesday, and that is going to be our capital corridor. And we're going to be all around that today, obviously, and our economic corner. An economic corner will be tied to our topic today. And then AI and question mark that just kind of permeates all the way through the body, the soul, and the texture of Webinar Wednesday today. So we'll look at those three areas to help you succeed. We'll take your questions live after the presentation. So if you have presentation questions, related questions, please go to the question box, go to the chat box. We'll find them once uh, the portion of this is over. And then also, the chat box today is going to be manned by our webinar producer, Maureen Busher-Dang, and no poll today. A lot of material, too much material. Had some great poll questions, but we're going to skip those today. So starting off with our capital quarter, as we will oftentimes do this segment of the webinar, it's just going to be a lot longer sections, is jumping into a little bit of data that we've had and we've shared in the past, and that is going to be our partner report from the Federal Reserve Bank. And we're going to kind of go over some of the research that's been done by the Federal Reserve Banks. One of them is a small business credit survey that we share some of the data with. And then another one is going to be one conducted earlier this year that is with senior loan officers. So it is the Federal Reserve Bank Senior Loan Officer Opinion Report, and it kind of gives us some trends on where banks are going. We're not going to, identify specific banks, and just generally by the nature of small business lending, lenders are going to have different ways to how they require and a lot of different various factors on how what they want from a small business, the types of industries and businesses they want to fund, and just their lending overall. And that could even evolve for individual lenders. So it's a little better for us to kind of look at a survey and to kind of look at what is being reported on kind of an aggregate level and kind of what is the trend and what is the trend that a viable organization like the Federal Reserve Banks are going to share. So first, we're going to look at just kind of what we're seeing is the level of use of AI, some of the importance and challenges. And the use of artificial intelligence, the percentage of firms that currently use it is a little bit less than the national average. You'll see us coming in at about 41%, 46%. So, and then also we have a higher use for not using or having plans to use AI. Now, those that uh, we're not using but plan to use is about the same. So our adoption level for the Southern San Joaquin Valley, the Eastern Sierra, and the Central San Joaquin Valley are pretty much a little bit lower on actual use, which I think is important moving forward. You see that we have a substantially less number of individuals that responded to our survey. And recall that the gray is our documented responses from the 7 counties of the central southern San Joaquin Valley and eastern Sierra Range. So the level of adoption at the time of the survey, which was at the end of last year, was we were substantially lower on experimenting with AI, but much higher partially integrating. And then fully integration was substantially less as well. I view this as a positive when you really kind of look at those two together, those two middle uh, uh, statistical references as far as experimenting or partially integrating AI. I look at that as a very much a positive because partially integration obviously is a step up from just experimenting. This is one to where a lot of the AI was drawn from, the basic question was, which task or processes do you use for AI in your business? And the one that really kind of stuck out to me was we do more as far as customer service and planning and analysis, but less as far as the administrative uses and some of the processes for automation, where I think that we could see a little bit better opportunity and chances moving forward. And some of the AI related challenges, obviously, you're going to have issues with businesses that are starting a new technology. So what are our challenges? And some of that has been, accuracy. And that has been substantially higher with our particular response, our subset of data from the CSU, Bakersfield, and Valley Community SBDCs. So we'll see a higher ratio there as far as accuracy issues or concerns, and also ethical and social concerns. So those are the two areas that kind of jump out from our, and maybe some of you out there actually responded to this survey over time. And then also the reasons were given for those that don't want to give or don't want to plan on using AI. The reasons, and the biggest reason, of course, nationally was that it wasn't applicable to their business, which could change. It might not be applicable to your day-to-day operations, but as far as planning and things we're going to talk about today, as far as getting small business capital or funding, it very well could be relevant. So moving that into our capital quarter and looking at some of the other things is one of the things that we're going to look at today is on the borrower side of AI. And so we have seen this as a very positive step. We're seeing a lot of borrowers who are now starting to use, the business owners starting to using AI to prepare a lot of their loan documentation. And one of the big questions that we were oftentimes asked at the beginning of this process is, how long is it going to take me to get a small business loan? So usually the clock starts ticking is when the business owner supplies all the information that they're going to need to the lender. And so oftentimes that completed loan package can be your historical information as far as if you're an existing business, it's going to be tax returns. Tax returns, and if you are, for example, a corporation or an LLC, that is going to include a balance sheet in there, a profit and loss, and also the tax return that you reported to the federal government. So that gives an opportunity for the borrower or their representatives, and oftentimes we do this at the SBDC, is to actually do a historical financial analysis to where we take that data and we move it forward and look at the trends that are going to be happening. We're going to start seeing a lot more of this trend development and a lot more of trends that lenders use, and we'll get into that more in a little bit later. So some of the information that makes it easier is also maybe cash flow projections. So this is trying to get the borrower side of things together, because we have tax returns, we could have projections, financial projections or cash flow projections. We could have debt service calculations as far as financial calculations, and those are going to be financial ratio calculations on the debt service coverage ratio. and it could be the break-even analysis or a debt to equity. So it's a lot of financial analysis that now can be done a lot easier. And that's been real positive from a borrower side of things in putting the package together. When people ask me and go back to that question of how long does it take to get a small business loan, I generally will say 3 months, give or take, from when you submit it to the borrower. Now, a lot of borrowers will tell you 45 days. Usually, you know, and it will switch from borrower, but generally, when you're looking at more traditional types of business funding, not talking about a lot of the online lenders, but a lot of the normal structured term loans, credit lines, other types of products along those lines, 3 months. So in there also is going to be, a business plan narrative. And the business plan really is something that is really getting a lot of play these days. At the SBDC here, we have clients that use LivePlan. We introduce them to it and provide it to them. LivePlan, we think, is a phenomenal tool for actually doing the business planning. It does have an AI component in it. But in no way, shape, or form do we want you to use AI exclusively on writing your business plan. We see that as a trend lenders are talking more and more about getting more AI generated business plans that kind of miss out on the personal touch on how that person is going to, number one, plan their business to where they can execute it and make money and pay off the lender, of which they want to see. They want to see the cash flow coming from there, and they want to see how they're going to get paid back. So the business plan, for a narrative for an existing business that's been around 20 years, it could be just a couple of paragraphs along with potentially some financial information to show some of the trend analysis. Now, in a startup, you're at a different phase. You have no historical financial information, and your startup information for the business plan really needs to be focus driven on a lot of the financial projections. So it could be cash flow projections that kind of show with valid assumptions on how that business is going to be paid off. But still, a lot easier process than it used to be. So AI on the borrower side is trying to help you get loan ready. So along that line of getting yourself loan ready, there's a lot of things that can be done. You can provide summaries. You can check historical summaries. There's a lot more information on industry and competitor analysis, and that's going to continue to become an even bigger trend moving forward. As more users, more lenders use industry and competitor information, they use it already substantially in order to, from a financial side of things, compare how your business is doing in that particular industry. Then moving that forward is going to be incredibly popular and incredibly important for you to understand. There's also going to be some what if scenarios. So what if? And what if scenarios are important. Oftentimes when I see really good set of financial projections, I'll see a most reasonable outcome. I'll see a worst case outcome. And sometimes having two separate outcomes based on what's going to happen sales wise, because that's really what's going to drive it. A lot of the cost and a lot of that information on financial projections, a lot of that information is easy to find. It's easy to figure out. Sure, you're going to have some variations, particularly if you're in a Bakersfield summer. That electric bill might get a lot higher depending on how the weather is, for example. But the cost for at least an example are generally more stable. You're going to have examples of an amortized loan to where you can see how much of your loan payment each month is going to principal and interest. So you can see all of that, but it's really the sales and really understanding how important it is to have really good information when you try to project sales. Now let's move a little bit to the lender side. To summarize the borrower side, you have more tools, you have more information, you can do it quicker, you can do it faster, you can do it better. So on the lender side of things, traditional underwriting would use a lot of the things we'd usually refer to as the 5 C's. So the underwriting and the actual uh, approval of the lending process would start with credit reports and credit history. And it would also flow to cash flow. It would flow to collateral, also how leveraged you were, how much debt you might have already have, and how much debt you have moving forward. It could be managerial experience and also repayment capacity. So, some of the, AI systems that are out there, machine learning systems, potentially allow lenders to analyze far more information more faster. So whereas on the traditional side of things, it was a lender taking your credit report, your cash flow, looking at maybe your business plan, if you're a startup particularly, analyzing the collateral or the security you're willing to pledge, taking the leverage that you have, looking at that leverage as far as the money that you're putting into it, the skin in the game as you might want to call it. But also it's also looking at the management experience and the repayment capacity. So AI with machine learning potentially allows lenders to look at that much faster. So one of the things that we're looking at now is you've seen there's your traditional underwriting with the information that they have. Traditional underwriting, debt service coverage ratio, really an important financial ratio that we run through all the time with our borrowing clients at the SBDC. We want to make sure that your financial data is set to where it's going to meet that very important debt service cash coverage ratio. And that is just simply, we'll show an example of that, but it's just the amount of money that you have from a net income over the amount that goes out to service your debt. The collateral, the loan officer's review, and then eventually it's signed off. So AI enhanced underwriting that we're starting to see now has credit along with your behavioral patterns. Maybe it shows your credit score right now, but it shows behavior patterns that have changed over the past period of time or maybe trending forward. So maybe your credit had taken maybe a little bit of a beating for a while, and it's now back on a path to going back. AI underwriting potentially can pick that up faster than traditional underwriting. So we look at tax returns, but also maybe they're looking at transactional history, continuous cash flow analysis. I used to always come in here and talk about month-to-month cash flow forecasting for the year. And really what has got much more popular, as evidenced by a webinar, I believe last month, is the 13-week cash flow analysis. So now all of a sudden, AI and others are starting to look at a much more continuous cash flow cycle to where they're looking at cash flow on a regular and routine basis all the time. Well, we used to look at annual revenue or maybe on a monthly basis, but now it can go down as far as daily basis. And you see that with a lot of the alternative fintech loans that are out there, to whereas they want to see on a daily basis what your revenue trend is, and it's potentially matching an algorithm that they use to promote their products and to make their loans for their particular products. The debt service cash flow maybe now is being replaced by a predicted repayment modeling. Collateral, you're looking at multiple risk indicators on that. So maybe they're looking at the validity of the collateral and how good it is as long as and how it kind of projects over time. Because really, when an underwriter looks and grabs one of these loans, you're looking at 5 to 7 years. They're not looking at only today and next week or next year. They're looking that your business is going to be viably repaying this debt in 3, 5, and then say even 7 years at the term of that loan. So that's kind of how the underwritten side of things has changed and how maybe it's moving from the lender's perspective. So, we started off a little bit with the borrowers and how it's changing there. Here's how it's changing from that lender's perspectives. So with that Federal Reserve Bank January 26 lending survey, and this was to senior commercial loan officers that responded across the country, they found that banks were on net income more likely to approve loans to firms they believed would benefit from AI, and less likely to approve firms they believe would be adversely affected by AI. So now, according to lenders of earlier this year, AI is now becoming part of the underwriting process. So they're looking at, and we have a lot of businesses that are AI neutral, but really, I think that what banks are looking at is they're looking at that 5 to 7 repayment window. That's 5 to 7 years. And they're looking at transformably how AI is going to change and how it is going to change more businesses. And that is one of the more obvious reasons that we're starting to see moving forward that lenders really want to see small businesses participating with artificial intelligence for cost savings and other areas. So we talked a little bit about alternative lenders, and alternative lenders is where this is happening the fastest. Our definition of alternative lenders is slightly different from the one I'm giving you right now. So this is a very broad approach. And a lot of the alternative lenders that I'm going to be talking about here are going to be more of your fintech lenders. And your fintech lenders are like, hey, you have a business, you're using Square or Toast or some other point of sale system. You can demonstrate in there that you have sales on a regular basis. That's all new technology that they're using, figures into their algorithm, and boom, they can make a loan for you. We'll see what that economically costs in just a minute. But alternatively, you have a process to where you have an application and then you have the bank account connection that is also oftentimes tied to your credit card and debit card taking system. You have data extraction that can happen out of that. But also one of the positives is you have fraud screening. And there's a lot of money lost to fraud by lenders, and that is a good sign of what's going on with these AI changes. So we start with our application, we go to bank account connection, we extract the data out of the bank account, we look at and see that there's no fraud in our particular business. Underwriting, we get to the pricing to where they're able to adjust more and figure out the pricing, a decision, and funding. Now, a lot of that is happening with a lot of these online fintech lenders through an algorithm speedily. Now, I got to believe that most loans that we still have, that they start with a human being and they end with a human being, but there is already machine decisions being made for a lot of the cost of capital. So again, faster access to capital. I told you a lot of the processes that are going to take 3 months. And here there's some online that can get you capital in 24 hours. Does not necessarily mean better capital. Sometimes, paying a higher interest rate, paying more fees, and understanding that for the capital to get it quicker is better. If you're buying a distressed asset, for example, definitely. If you have a very short turnaround time where you can buy that distressed asset. But for most cases, generally, the price of capital is something you're going to want to consider in there. So generally, at the SBDC, we want to run every one of your particular funding opportunities through and compare APR. Again, sometimes it makes total sense to spend on a much higher APR or pay more in fees or to pay a short-term period, etc. But in most cases, we see that's not the case. And also, as a sidebar, it is getting harder for borrowers to refinance those out. And in many cases, you don't want to refinance them out anyway. Let me explain. So let's say you go through a fintech corporation online and they offer you a $50,000 loan. And they tell you that your fees added to the loan are $23,459, $56. The one thing they won't tell you is what your APR is, and that's your annual percentage rate that you're paying. In this example, I'm going to show you it's 49.49%. And how do I figure that out? Well, I have a calculator to do it the short way. But essentially, if you know 2/3 of the equation, you can figure it out. So if I know the amount being borrowed, the amount being totally repaid at 73,000 and the term of the loan over 20 months, I can then calculate an interest rate. Is the interest rate shared in that? No, not usually it's not. In most of the loan documents I see, you are shown a loan amount, the fees that are added to the loan, and also the daily payment for 20 months and the amount that's being taken out. So it'll show your payment amount also that will show right here on the loan calculator. So on the loan calculator, we have our $50,000. It's a short loan, 1 year, 8 months, 20 months. Every day, $120.67 comes out of that. Now, that's every day. That's Independence Day. That's Labor Day. That's days that your business is closed. So every day, $120.67. Doesn't sound like much, but over an entire month, it's a little over $3,600. So we did this based on here's the results by figuring out what the interest rates were. There's other ways to figure that interest rate out, but you got to know your interest rate. You got to know that. The example I gave you on the total amount of payments, the 23,456, we have clients that come in and say, gee, I really should get rid of this loan. The interest rate is really high. It's like I can get a credit card for less than half that much. And the credit card wouldn't repay as quickly. So 23,456 for the amount of total interest there is charged no matter when you repay this. If you repay it after 1 day, that's great. If you repay it after, the full term, 20 months, it's still the same amount that you pay back. So if you paid this back halfway through the loan, theoretically, your interest rate then would jump to 98.98%. And there's our wonderful calculation on that. Okay, so there's your formula. APR, extraordinarily important. So how could AI expand the definition of creditworthiness or change it? We have two very basic illustrations here. And what I want to do is don't want to focus on all the aspects of it. Business one, has got a 720 FICA, 720 credit score, 650. There are many loan programs that we deal with that have a minimum credit score. And then there are other ones that don't. And this is a good example of where a lower credit score is actually, in my opinion, a safer and a better borrower or borrowing candidate. So, and again, it's going to depend on the size of the loan. It's going to depend on the lender and how much you use it for. But here's an example where you have a 720 credit score, limited operation history, and uneven sales. But yet business B has 5 years of history, and they have pretty strong reoccurring deposits and stable customers and a positive cash flow. For me, and a lot of the lenders we work with that are cash flow lenders, they're going to tell you right off the bat is that I like borrower B better, despite the credit score. So many of the lenders that we work with, and we just literally have 50 different lending sources that we work with, 50 different funding sources. Some of them, and they're all over the map over what their minimum credit score is, what they have a minimum credit score times, the loan amount, the amount they go up to, and it's really kind of a difficult process. So it's very humanized, and that's really one thing I really encourage you to reach out to the SBDC about. So one other thing that we're learning from AI is it can actually become the world's fastest know. Machine learning can tell it's making lenders much better at spotting a lot of deficiencies that they don't really want in their borrowing clients. So much quicker, it can look at your bank deposits if that's part of the application process. They can't look at them if you don't provide it to them, but they can see the declining deposits. They can see if there's been an overdraft frequency. They can look at your margins and they can look at your margins. And, we're big margin people here at the SBDC. Love the margins, love the high margins. So if those margins are deteriorating or changing or impacted by something that's going on in the business, it's important to find what that is to restore that particular margin. Excessive existing debt. Um, you know, that could make lead to a no, but it also could lead to another opportunity is if it's higher debt, higher interest debt, that it could create quite a savings in order and then actually create a cash flow opportunity where it improves cash flow by getting the new loan. So the cash flow volatility, wide swings in your cash flow and usual transactions. And then of course one that we don't need to worry about, but it's potential fraud. So jumping into our economic corner portion of it, we're going to just talk a little bit about AI risk now and about how AI risk becomes credit risk. So how is this so? Okay, so imagine that we're now evaluating two separate companies. One company is, let's say, Company A, accounting, bookkeeping, businessly aggressive, implementing AI. Company B is traditional administrative services, whose could be substantially replaced by AI. These businesses have the same, discounted cash flow service ratio. They have the same credit score and collateral, but banks are starting to say that they're not the same credit risk. So taking the credit risk theory that they did in the past and using traditional underwriting is going away with some of these that are now saying that if they don't have substantially some of their activities leaning toward AI, then they are more of a credit risk for that particular bank. And that really was kind of proved throughout the Federal Reserve's 2026 Senior Loan Officer Survey. And they were asked specifically about a few things. And banks reported, becoming more willing on net income to approve commercial loans to firms benefiting from high AI exposure and less likely from those adversely firms affected by AI. So, for me, it kind of is like, can this business repay the loan and will the business model be competitive 3 to 5 years from now? And that's really what, if loan officers are saying that at the beginning of this year, this is a trend that is going to become much more prevalent over the next short period of time. So with that, historical performance that we can document, plus current financial projection, plus future AI vulnerability opportunity for now is equally in credit risk for lenders. Lenders don't like credit risk, and really they do as much as they can to reduce that. So what are some of the tools here that we can help you with at the SBDC? The SBDC has a number of tools. We talked about our LivePlan tool. The live planning tool is one that you can engage with your advisor. It is free of charge to you. Our SBDC Central California region has LivePlan licenses that allows us to allow you to use LivePlan and you do the business planning and do the business planning process for your particular loan for a shorter period of time. So LivePlan is a great tool that we have. We have also Vertical IQ, which really looks at a lot of the analysis that you can get from your advisor. And the Vertical IQ is a great tool because number one, what it does is it provides the same scorecard that your lender is going to be looking at. They're going to be comparing financially your business with the particular industry that you're in. So taking that particular business and looking at it, how it fares in the industry is something that lenders will do to see how effectively managed your business is and how much risk they will have in your particular loan. So Vertical IQ also creates a wonderful analysis, really good information that really kind of helps you with your assessment of your business moving forward. We shared with you some of the findings from the credit reserve survey. We're going to start implementing some of the 2026 senior loan officer because it's really, I think, incumbent for us to know what loan officers are thinking ahead of time in order to get out in front of that. So here's some of the opportunities that you have, some of the tools that we have to assist you in getting in front and helping you package your loan. Additionally, the one thing that's not in the toolbox is our relationship with lenders. And those go from lenders that are large scale lenders that will lend from a half a million to 500 to $50 million. Relationships that we have with a lot of SBA lenders that will go from anywhere, from the SBA micro stuff, small stuff, but then typically go up into the millions of dollars, both with their 7A project, which is a guaranteed loan program, and also the SBA 504 program. So being powered by SBA and having all of the relationships of SBA and their loan officers and loan programs, we like to work with SBA loan officers that are local and lenders that are local. However, in some cases, it is best that we work with regional or even national lenders to assist you in getting the capital that you need. And never, with our advising, is there any ever a fee or ever are we paid for your transaction being successful. If you'd like to contact us, for confidential, no cost, no obligation expert consulting, you can go to our website and actually sign up at csubsbdc.com. We're here to help you. And really, I think that one thing that we've excelled in over the nearly 15 years I've been at the Cal State Bakersfield SBDC is getting clients ready to access capital. And it's an ever-changing idea. It's ever-changing out there what is going on in this particular field. We have been using a lot of our student engagement and projects that we work with is through the America's SBA AI University. And there's your contact information that you can contact me. I wanted to make sure I left plenty of opportunity for you to ask questions and to come in with some questions. So now is going to be the time for you to do that. Okay. Hey, got a lot of questions. Let's jump into the questions right now. The first question in the Q&A box is, are there grants or loans available to help a small business with adopting to AI or in other technologies? Well, the grants are going to be a little bit limited. They're going to be, the city of Bakersfield, if you're located there, they still have some money available. And also, beyond that, you're looking at smaller loans. It's going to come down to about how much you need and what you're going to use it for. You could be hiring people. It could be, there's a lot of different ways to go with that. So getting ready, adopting AI and do it for purposes of saving money and cleaner administration. It's great to look at. Great to do some analysis on that and really should do that. Next question, what if AI makes a mistake or hallucinates and the lender turns me down? Well, that is going to be perhaps some of the growing pains. The thing that's going to be important is to get the lender to acknowledge that they used HI or AI. Using AI, yeah, possibly. So if the lender uses AI and makes a mistake, hallucinates, turns your loan down, then I don't really see a lot of recourse. If it's marginal and material that you could actually go and improve, say it evaluated something inappropriately or incorrectly on your cash flow, and you can go in there and demonstrate that you have cash flow and the assumptions that you use, it's possible. So I think as lenders continue to, and commercial applications exist for this, what we're going to find is we're going to find that there are going to be fewer mistakes in AI with mistakes and hallucinations. You're going to find that they double check, because oftentimes I know I will even do that. I'll go in doing something for a client and I will double check a couple of different variations to at least have it acknowledge the same thing twice. So I would assume those safeguards are going to be in place. Okay, next question. What should I ask AI before meeting with a lender? That's a terrific question. Okay, so if it was me, what I would do is I would have it evaluate some financial ratios. We've talked a little bit about cash flow and your cash flow ratio as far as your debt service cash flow ratio and cash flow. I would definitely have it do that. Other things that lenders are always wanting to know is your debt to equity or your leverage ratio. We talked a little bit about leverage earlier. So your debt to equity is just going to show how much money you've invested in it or you've had invested in it compared to how much debt that you carry. There's some liquidity ratios as far as working capital trends, break-even points. So there's a lot of stuff that you could ask AI. Now, the one thing you have to remember is that if you have an open system, your confidential information could go out there. So it is best to use a closed situation, use a closed AI. For example, here at CSUB, we have ChatGTP and we have the university version that is closed, that's closed and non-sharing. A lot of research work goes on with the CSUs and other confidential information. So the machine isn't learning from information that we're putting in that. Free versions, it's learning. So you have to be very careful on what you put in there because you don't want somebody actually posing a question about competition in Kern County about your particular business and have your information start throwing out on AI. So be careful there. Can can AI prepare my projections? Well, I don't think we don't use it to that degree yet. Um, what we do is with AI, what we do is we actually help build and then we stress test them. We put the assumptions in, um, and AI can do all the math, but you still have to defend your assumptions. And remember that is such a key part of financial projections is what you're assuming goes into those numbers. Can AI write my business plan or my loan narrative? Well, we talked a little bit about that. And be careful. I think it's okay for a limited basis, but lenders don't want to look at a 50-page business plan that has a lot of narrative. A lot of it's been generated by AI and a lot of numbers. Um, let's see. Some other questions. Are, you know, are banks actually using AI to approve and decline loans now? And I think I kind of answered this earlier, but yes, although the degree varies considerably. You have automated models, you have fraud detection, you have document extraction, cash flow, scoring models, algorithms that are looking at a lot of the data in there. So I would say the answer is yes, but the degree that each individual lender uses that can be considerable at times. What information can the lender's AI see about me? That's, well, you guys are on your game with questions today. So potentially much more than a conventional credit score, I would think. So I would think they see much more than your credit score. They're not going to see your 3-digit number. They're going to see detail behind that. And it depends on what the borrower authorizes and the lender uses. So again, I think we talked about a few of these. We talked about some of the bank transactions as far as probably, bank statements. Bank statements are pretty popular. That'll show, transactions that you've had, deposits, withdrawals, overdrafts, etc. And I'll follow up to that. Does this mean my bank activity is becoming as important as my credit score? Increasingly, it can be, for sure. Definitely, for sure. That's particularly important where conventional credit lines don't fully capture repayment capacity. Can AI also get me declined faster? Sure. That's the other side. We talked on this, and AI can quickly identify, weaknesses that you potentially have. Oh, this isn't, my friends aren't going to like this question too much. Will AI eliminate loan officers? Well, now remember, loan officers are kind of different than they were 20 years ago. 20 years ago or so, old school, you know, you'd go see a bank and you would talk to the loan officer, and the loan officer would take you all the way through the process. Some of them even had authority to approve certain loans up to a certain amount. So now they have been replaced with more centralized, in most institutions, not all, in most, they've been replaced with more centralized decision making that is either done by a loan committee, it could be done by a credit administrator or a chief credit officer. Chief credit officers have a lot of pull also, and oftentimes will sign off on every deal a bank will do. And usually that's a deal over a certain threshold or size amount. So will it eliminate loan officers? No. Um, and you still need those marketing people that are in the branch now who are technically loan officers, and they're the ones that are working with you through the process. They're helping you get your information together. They're packaging the loan. They're signing off on it. They go, well, yes, I like this deal. And then it goes upstream for underwriting and further analysis. Okay. What if I'm in a high risk industry, but I have a great AI strategy? I like that. And I think a lender would like that. I think that's kind of what they want, or maybe exactly what they want to hear. Here's how AI threatens our traditional business model. Okay. You're in a high risk industry. So we're identifying that as a high risk business model. And here's what we're going to do about it. I think that that's compelling and shows that management is strong. And you're not, in a fishbowl looking and pretending that the AI threat doesn't exist. So which businesses should be most concerned? Okay. So, first of all, I wouldn't say that any particular industry is unfinanceable at this point. Anything can be financed. But the focus has got to be on the business activities. So routine information processing, repetitive administrative services. Um, focus on those that are easily automated, perhaps an analytical task deserve particular attention, and see where that cost and time savings really falls and where it is. Okay, so looks like we have a couple more questions. Still not too late to get in your questions. Um, um, you know, one kind of back earlier to the first question that we answered, and I think it's a good enough question. Let me throw you at it one more time, and that is, could a business borrow money specifically to adopt AI? And one resource that we will include when we send this out to those that attended is here at CSUB, there is an effort going on by one of our business and public administration professors. And he is actually working to try to find 15 businesses that maybe cannot afford AI at this time and look for ways to do that. So could a business borrow money specifically to adapt AI? I would say definitely, because financing programs go down to a small amount. It depends, if you're looking, it's still, again, it's got a cash flow and makes sense, but it is not going to be a criteria that is not fundable. I think that AI threatens part of my business. Should I tell my lender? I'm a firm believer that your lender is looking at the same facts that you're looking at, maybe not all the financials yet, but he will at one time, or she will. And so, should I tell my lender that AI threatens part of my business? Definitely. If it's material and immediate, and explain your strategy for what you're going to do, why it threatens your business. So here's a threat that I have in my business created by AI. I've identified that. And now what is my strategy for mitigating that? Um, a good lender will look at that and they'll say that you already understand your industry risk. And acknowledging it and presenting a credible response, that's management competence. Management 101. That's what we love to see. You've seen a problem and you've objectively analyzed it and determined what is in your best interest to move forward. Could AI eventually determine my interest rate? Oh, you know how we are with interest rates. Um, You know, that's a great question. I think already you're seeing that. You already see risk-based pricing decisions already made. You see risk-based pricing based on credit scores when you go buy a car. You could see it through a variety of different aspects. And I think you already see it somewhat in SBA loans. For example, an SBA lender can, basically charge prime rate, the going prime rate, and then up to, say, 3%. That's, I think, the mandate, 2 3/4, 3%. So, but if there's less risk, a lender could charge less. If it's more competitive, if you have more options on getting funding, they can come down to prime plus one, or prime less than one. Prime. Why not prime? So I think that's a great question. And eventually, can it determine your interest rate? Very possibly. And already risk does in some way, shape, or form compensate for the amount that you're charged as far as an interest rate anyway. Okay. Isn't all, is this AI stuff overblown? I talked to my banker and he knows me and doesn't need an algorithm. You got a good banker, keep him. Um, you know, Relationship lending isn't disappearing. The fact that these tools are used more in the decision-making process, helps a lender avoid some types of risk, but relationship lending isn't disappearing. That's why when you come into the SBA, the first question, when you want a bank loan, you want to go through a particular bank or an SBA, we want to know who you bank with right now because we want to keep you in that banking relationship if at all possible. You've already got merchant accounts there, your credit cards, maybe you've got a payroll, etc. So we want to keep you in that relationship. Okay. Last question. Let's end on a dandy here. Hey, I even get addressed by name. What do you know? Kelly, if I came into the SBDC tomorrow wanting 250,000, what could AI tell me about my chances of getting approved before I ever talk to a lender? Well, I think that was the intent of today. And to look at the three tiers that we talked about, and to look at, from the standpoint of what you can do from a borrower, but then also what a lender is going to look at and how a lender is going to perceive risk. So, you know, AI can evaluate the borrower. It can anticipate what the lender's technology will see. It examines whether the company, industry, and business model strengthen or weaken its future capacity to repay this loan. And that's what it comes down to is repayment of that loan is what lenders are looking at. Perfect question to end on. And a perfect question to wrap up Webinar Wednesday 387. Wow. We'll be back soon for Webinar Wednesday 388. For our producer, Maureen Busherdang, Kelly Bearden, have a fantastic rest of your week, and we will see you soon. Goodbye, everybody.